Mark Lichtenfeld, how do I get rich with dividends?
Well, the first step is read my book. But really what you want to do is you want to invest in companies that I call perpetual dividend raisers. These are companies that are raising the dividend every single year, and you reinvest those dividends. And the magic of compounding is really pretty incredible. I mean, you take a stock, a boring company, let's say like a McDonald's, and you quadruple your money over 10 years. Over the past 10 years, in what was a very flat market, by reinvesting those dividends, 10,000 turned into over 40,000.
But how do I make sure that dividend is safe? Because a lot of times the stock with the highest dividend is the least safe stock.
So what you want to do is you want to look at the payout ratio, which is the percentage of earnings that are paid out in dividends. I like to take it a step further and look at cash flow, because earnings can be manipulated. There's depreciation and amortization. So I look at cash flow from operations. And as long as a company is below 75% of the cash flow from operations, then it's generally safe. 50% or 40% is even better, because then the company has plenty of room to raise the dividend and suffer, and get through some perhaps negative years.
What about MLPs or REITs? They traditionally offer very high dividends. Are they smart plays as well?
They can be, absolutely. You have a higher yield. There's, especially with an MLP, there are certain tax issues you need to be very aware of. You need to talk to your accountant or tax professional about that. But yeah, they do offer higher yields, and some of them are great businesses. Particularly some MLPs, they're almost like toll booths for gas and oil pipelines. So there's not a lot of expenses in running the operations, and they just collect money every day and every week.
Now, you mentioned McDonald's before. Are there any other dividend plays that you like right now?
Yeah, I like Intel, which I think a lot of people would probably be surprised that it's still kind of viewed as maybe one of the four horsemen of tech. But they've been paying a nice dividend, raising it every year for the past 9 years at an average rate of 26% growth per year. Now, last year they slowed down to 24%. But most people would be very happy with a 24% boost in any portion of their income. And that's just the company during all the different cycles of the semiconductor industry. They just keep churning out a ton of cash and paying those dividends.
So finally, if I want to get rich with dividends, like the book says, is it better for me to find those perpetual dividend raisers myself, or buy an ETF like the DVY, or buy a mutual fund that emphasizes dividends? What's the best way?
I think you definitely want to get your own portfolio of stocks. And the reason is because the ETFs and the mutual funds, they don't have that track record of raising the dividend every year, even if they're investing in some of these companies. So to me, the track record of these companies is the most important thing. So you invest in a company that has a 25-year track record of raising the dividend, chances are they're going to do it again. And that's the key part of getting rich and increasing your income every year, staying ahead of inflation, and maintaining your buying power.
This market is
stock tickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to